Morning once again. We are proceeding with our series on financial management, and we are going to look at the main goals or the objectives of the firm from the business aspect. We all know that the major aim of the firm is to maximize profit. Every person who starts a business, we expect that what they are trying to get out of the business operation they are doing is profit. So from that, hope you're not starting from zero, because you know everything that when the business is starting, we are aiming at making profits when we are minimizing costs. So we've seen that if you want to get the profit, you get our total revenue, you less the total expenses we've incurred in the period. That's how we get the profits. But with the business, since the business has a lot of aspects, we shall be generating income statements. And when you go through the income statements, we have all of that, as you know, from the financial accounting until we reach the net profit. So when we get the net profit, it will be that will help us to know that the company is making a profit or is getting a loss from our income statement. So let's start. And we are saying profit maximization as one of the major objectives of each organization or firm, especially for those that are not non-profit-making organizations. For profit-making organizations, we expect that their goal is to maximize profit. Okay, we are saying that profit maximization, this is the traditional objective and is a situation where the firm maximizes its revenue while minimizing costs. Therefore, the decisions have to be made to maximize revenue and minimize costs. We've seen what decisions the financial manager can make, so that we'll be able to understand how we are going to be able to get the profit the different stakeholders wants upon the setting up of the business. We are seeing that to get the maximized profit, it will be our maximum revenue minus the minimum costs, because we are saying we are maximizing profit. So profit maximization is at a point where the maximum revenue, when we less it from the minimum costs, we get the profits. And we are trying to look at what will be the advantages of this objective. If the company maximizes a profit, then what's the advantage of that? One, remember here we are looking at the major. One is when the profits are maximized, the shareholders are going to be satisfied, because their primary objective when they contribute their money is to make profit. So when they achieve that, then we are going to say that the shareholders are satisfied. And these shareholders, these are the people who pull money and they start the organization or the business. The shareholders, they are different from the stakeholders. Shareholders are part of stakeholders. Those stakeholders may be the different people who have interest within the organization. It may be in the government. How the government has interest in an organization is by looking at how it will be able to pay taxes. They may be the public. They're looking at how the organization is treating them in source of in terms of social corporate responsibilities, like not polluting the environment, providing the goods at a cheaper price. They may be workers, as we've seen those users. These are the users. Now, the second objective is to maximize. The second objective, the second advantage of profit maximization. Maximizing profit is seen as a sign of efficiency. If, let's say, you've performed well in this financial year and the next financial year you improve, we shall see that the management is improving or is doing better. So it will be a basis for evaluating the management we've hired. If, let's say, the shareholders have hired to do the business for them, it means when we see the profit, we expect that efficiency of the management is achieved, and that acts as a yardstick against which the performance is measured. So we can look at, remember, if the company is just aiming at making profits only, it means it will do anything without caring for anything, so long as it is making a profit. So what happens is that this profit maximization objective to different stakeholders, now I'm not talking about the shareholders, I'm talking about the different stakeholders. It may not be the aim for them. If, let's say, the company has got profits, but it has been polluting the environment, the people are not benefiting, it is selling the goods highly, it is producing low quality products, but since its main aim is to get everything in terms of profit, it brings us to a certain criticism that come up and say that, look here, if the main aim is to make profit, yes, we are not denying that, but there are other aspects that are ignored within the aim of making profits. So these are the things we are going to look at. We are going to look at the advantages, the limitations of profit maximization. We are saying that the profit is okay, it is there, because what happens in profit is, if, let's say, someone say, I've made a profit of 10 million in let's say 10 years, you will see that you've made a profit. But in actual sense, if you try to convert it in time value of money, you find that it's nothing. Those are the things we are going to look at. We are looking at the limitations of the profit maximization objective. The reason why we are looking at this is that we are trying to look at, if the shareholder aims at making profit, what are the likely things that the person can do and they are not in a good way of the organization itself to either the public and other people. We are saying that the term profit is vague. The term profit maximization objective is vague. This one is the term profit maximization objective is vague. It is vague in a sense that it doesn't classify what it exactly means. What do I mean? It conveys different information or different meanings to different people. Like if you talk about the accountants, for them, they know that profit is excess of revenue over expenditure. It means they are getting the revenue minus the expenditure. That's how they get the profit. That's to the accountants. But to the religious leaders, for them, they define profit as a spiritual benefit in addition to money. It's not, if let's say someone is blessed and that person has money, That's what they understand by saying the profit. That's how the religious people understand that. The other scenario you can look at it is to the economics, to those economists. You find that for them they get the aspect of profit in terms whereby they're including even the other social costs, the social costs, sunk costs, and all of that costs, which may not necessarily mean that the company is making profit. So it is a limitation in the sense that it doesn't clarify what it exactly means. Someone may say, I made a profit, but in actual sense, it wasn't a profit. Or different people perceive profit in different manner. So if you are trying it that way, then it doesn't make sense, or it becomes slippery to be targeted by the firms. So it's a limitation. And we are saying profit maximization objective is vague in that it doesn't clarify what it exactly means by conveying different meanings to different people. You can give the accountants, because for them they see it as an 11 minus costs, and the religious leaders, for them they see it as the spiritual benefits in addition to money. That someone is blessed, so he has something at least more than other people. The other one we can look at it as profit maximization objective ignores the timing of profit. That's what I've been talking about. The timing of profit is very key. Take an example. If let's say someone tells you that I'm going to give you that the company in the whole financial year made a profit of, let's say, 1 million. It's a profit. But if you try to convert, remember that money was got at the end of the financial year. If you try to divide 1 million divided by 12, you find that you've made nothing on a monthly basis. So if someone tells you that when we do the business, we are going at the end of the business or at the end of the year, we are going to be getting 1 million, you will ask yourself, can't I make that 1 million within a month? Because when you try to compute that, you will just see that you've not been doing anything, because at the end of the day, the money that will be remaining will be just few, because you're saying this, yes, you made a profit, because for them, the profit maximization just looks at the extent when the revenue is exceeding the costs. But in actual sense, if you in 1 year you get 1 million as a profit, the timing of profit is not taken into consideration, because for them they compute whenever you are computing the financial, you compute it in 1 year's time, in 1 year's time, in 1 year's time. But if you don't take into consideration the timing of the profit, then you are not adjusting to the time value of money. And if you're not adjusting to the time value of money, then you cannot address the concerns of the investors. Because for the investors, for them, if you're committing huge amounts of money in, let's say, certain investments, you find that some investment, they can even take 5 years to get a profit. If, let's say, someone has been planting, let's say, eucalyptus trees, which take like 5 years to grow up, 5 to 3 years. And you find that for you're telling the person that I put in this, but I'm getting this, but you don't consider the timing of the profit. If you're not considering that time value for money, because when the money today is not the same as money for next 10 years time, or the money you've received today is not doesn't have the same value like the one you receive tomorrow. Because the money you have now, you can use it for further investments. You can also it can also help you to make consumption, to pay the unnecessary, the unforeseen expenses that may have arisen, or that may have arose from the daily operations you are trying to look at it. So we are saying that it is a limitation that profit maximization objective ignores the timing of the profit. Hence, by not adjusting to the time value of money, the profit maximization objective failed to address the concern of the investors. Because for the investors, they want money, not just a mere giving a statement that when I sold this, I listed this, but we got this. But yes, we've got a profit, but how long has it taken us to get that profit? So that's a limitation. And the other one, we are saying that profit maximization objective is too narrow. For it, it looks at the revenue minus the expenses. And when we get it, when we get a profit, it says that everything is done. That's being too narrow. It fails to take into the social corporate, the social consideration, that's social corporate consideration or responsibilities and other obligations to various interests of people. Like to workers, someone may say that we've been getting profit, but you've been underpaying workers. The workers are not happy because for you wanted to maximize the profit and you are leaving the workers with less money in terms of the disposable income. It may be the society, you are making profits at the expense of the public by polluting the environment. You are not recycling the wastes, you are disposing them and you're causing pollution to the environment just because for you wanted to make profits. Then the other one we can talk about is to the government. You've maximized the profit, yes, but you have not paid, you've dodged paying taxes. You've doctored the financial statements in terms of where you want to be benefiting, but the government is losing money. Those are the things. For it, it is too narrow. It doesn't take into account the social corporate responsibilities and obligations to different interests or stakeholders. The fourth one is profit maximization is as a result of perfect competition. And you know from your economics that perfect competition, those market conditions, they don't, most of the times they don't exist, especially in developing countries. These developing countries like Uganda, you find that the things are not existing. So when they are not existing, we expect that you are going to misallocate the resources. Because if it is based on the assumption of perfect competition, which doesn't exist, then we expect that you are going to allocate resources on items that are not going to be beneficial to the business. So the business will end up making losses. The other one we are talking about is profit maximization may result into investment in high risk projects, which may lead to collapse of the business. The reason why we are talking about these high risk projects, you may find that those projects which has a high risk rate, they are very profitable. But what happens is that if you base that for you want to make profits, you'll even be tempted to go and invest your money in a very high risk venture so that you can achieve your objective, which will make the company to go into a loss. Because especially when you talk about this betting, if let's say you are the kind of person who is involved in betting, you find that betting is very slippery to the extent that you can put in your money and you lose everything at once. So those are the ventures. If let's say someone is doing something that is very profitable, if at all you get it through or you get it right, you get the money. But at the end of the day, there are high chances of you losing. And when that happens, we expect that you are going to incur total losses instead of the profits that forced you to go into that venture. So that's how we look at it in the sense of the limitations. And we are saying the only something that can limit or that can remove those restrictions or these limitations is the wealth maximization objective, which we are going to be seeing, because for it, it appreciates the benefits of the profit maximization objectives as a result of reducing the limitations of the profit maximization objectives. And to achieve that, there are so many things we have to first understand. First of all, we understand what the shareholders, the different stakeholders want in the business. We get what is their influence, as in terms, if let's say they are employees, what's their influence in terms of the company's performance? What is the influence of the government in terms of its performance? What's the influence of other stakeholders, like the financial institution? What's their influence as far as the operations of the business are concerned? When you look at all those aspects and you combine and you try to eliminate what the profit maximization objective was ignoring, then you are able to look at a situation where you are going to be aiming at creating the wealth or maximizing the wealth, which is the main emphasis for the shareholders. For them, their aim is to maximize wealth, but it is not their aim to maximize profit. No, it is the aim of the business. We go into business to make profits. But for the shareholders, they are saying that it's not all about maximizing profit, but you have to maximize wealth. And to maximize wealth, you have put in other aspects, as we are going to see them, in terms of market, in terms of the social responsibilities, in terms of the government policies and others. When you have incorporated all of that and you'll be able to achieve that, including getting the profit itself, then we are saying that you've reached at a point where you are maximizing the wealth, and that's the main aim of the shareholders or the owners of the business. Let's look at the other objectives. And these other objectives, these are the subsidiaries. These subsidiaries, they are the ones that we do that lead us to the wealth maximization. There are two main objectives of the business. One is to maximize profit. The other one is wealth maximization. But to maximize the wealth, you must do other things in terms of market, social responsibilities, engaging the government and others. That's the only way you can reach at the maximum wealth. And we are saying there are subsidiary objectives that a firm may focus on. These include maximizing market share. By maximizing market share is you are looking at the company dominating. If let's say it is in the production of certain commodity and it is dominating the entire or almost the entire population, and people want the item, and to do that you incur certain costs. Remember, the profit maximization objective was aiming at minimizing the cost. That's why they did not go into the market share. For them, what they looked at increasing the prices of the commodities so that they can be able to get that. Monopolizing, but monopolizing, you are creating artificial monopoly, or you may create artificial shortages of raw material, of the output, so that you can increase the prices. Those are the tactics, the primary role of the business, that's profit maximization does. But here we are looking at, we maximize the market share, we maximize the earning per share. Earning per share comes in when the company provides good quality products, they are not too expensive, the company is known in the public, it does some social responsibilities to the general public, and the public has a very good image, or the company has a very good image in the public, and the public has trust in the company. When that happens, we expect that if the company tries to sell out shares to the public will be willing and able to support the company, and the company can be able to set or to earn more from their share capital. And the other one is maximizing product quality. Maximizing product quality, it means you produce goods of a very high quality, they are very healthy, and they are not too expensive to the extent that they can scare away the customers. When these objectives are taken individually, when we attach each and everything from there on individual basis, we expect that we are going to be having an optimal or a maximum market share. When these objectives are taken individually, they address the concern of the subsystems. And these subsystems within the overall business system, we are talking about these other departments within the organization. They are therefore not optimal. For example, a maximum market share may be achieved at the expense of too much financial resources spent on the marketing effort. Because to get a market share, you either be able to market your products every time, and when you're marketing the products, it means you are incurring high marketing costs. If you're not doing that, then we expect you to deliver at least a very good quality items that can make the public buy them and love them, but they are not also too expensive to scare away the customers. When you are doing so, we expect that you are going to reduce the cost or the price of those final products, and that will be at the other way or the other, it will bring a loss to the business. So their implication of the weaknesses of this objective is that the objective of the firm should cater for the interest of all parties interested in the business, including the public, employees, government, and all other stakeholders that have interest in the business. We have the incorporate, it has to incorporate the risk stroke return trade-offs. These ones we are going to look at them in the preceding videos, and we see how we can compute them and address the time preference needs of the investors. Time value of money is important in every aspect of finance. That's why we are saying that when these objectives meet these requirements, then we expect that we are going to be having a wealthy maximization. The whole of what we've been going through, the maximizing marketing share, maximizing the earning per share, maximizing the product quality, we are trying to make sure we get the wealthy maximization, and that's what we are going to look at, and it will be our last slide for today. Then the next video will start from the cost of capital and the capital structure. Okay, we are saying the wealth maximization objective. This is a broad objective or a broader objective which recognizes the strength of profit maximization while resolving its limitations. The wealth of the firm refers to the net benefit accruing to the firm in the form of cash flows from all assets in which the firm has invested. We are looking at what will be the benefits or the net flow or the net profit from the investment we've made, from the assets we've acquired, and what will be the benefits that we are going to be receiving from all these aspects, but taking into consideration the time value or the time factor, that is in terms of the time value of money. Yes, we are looking at how are we going to be receiving these cash inflows, but we are trying to make them, because when you make an investment, if let's say you buy materials that are going to be used in manufacturing or machines that are going to be used in manufacturing, we expect those machines to be working for a long period of time, and that's futuristic. So if it is futuristic, we expect that, let's say we are going to be receiving 10 million every year, but we want to convert that money and we make it, how much will it be now? How much will 10 million be now? That's what we are trying to look at when we talk about the time value of money. We are converting the future money we are expecting to receive into how much will it be in if we get it now. That's what we call discounting. We are going to say that in the preceding videos, and we see how we can get to that. But what you have to know is that when you are looking at what the net benefits we are going to be receiving from the investments we've made, we are looking at the benefits and also the time factor. We are considering how long will it take to get the money we've put in, and what will be the profit if at all we go to the lifespan of the assets we've purchased. So we are saying that the maximum wealth is got by this formula. This is the formula, and our A here is representing the expected inflows. I've said you can take an example. If let's say you buy a car of let's say 10 million, that 10 million you've bought that car becomes the cash outflow, and the cash outflow here is represented by I. This is the I, the cash outflow incurred in the acquiring the asset, and it's also called the initial outlay or capital outlay. So if you buy a car for 10 million, we expect that how much are we going to be receiving if let's say if that car will be there for 5 years, what are we going to be receiving each year until we reach the 5 years? Those 5 years, they are going to be our N, and this N here, you are seeing the N, this N, it means that even this one it represents the period. It is A1, which means the cash inflows in period 1, period 2, until we reach the full lifespan of the asset. What we are looking at is that we want to convert, if let's say in each year, if we bought it 10 million, and each year we are going to be receiving 1 million. Let's just use that 1 million. We are trying to look at what will be the discounting rate, or what will be the required rate of return. A required rate of return is the minimum amount of money we are expecting to receive when we commit investment, or when we invest in certain fixed assets. What will be the minimum? But that minimum, remember, we are trying to look at that minimum and we multiply it by the number of years. But this time round, we are computing it. We are trying to get that if, let's say, we are expecting in 1 year, the minimum we should get from investing 10 million in a car, it should be 800. Then it will be that 800 divided by what we are receiving every month. Because what we are trying to look at, it is a rate. What will be the rate? What will be the rate of profit that we are going to be getting? If you put in 10 million, if the car is going to be there for, let's say, 5 years, we are saying that if at all we are supposed to receive 800, it will be 800 divided by the cost, so that we'll get which percentage are we going to be using to make us reach to where we want to reach. Because you can discount this. When you're discounting this, that amount, we are saying that that minimum is what we call the required rate of return. And here we are saying the minimum rate, the required rate of return by the investor at which the cash flows are discounted to obtain the present worth. These are the cash flows, what we expect. These are the cash inflows we are expecting to receive every year. So we are trying to discount those. We are trying to convert those futuristic incomes into their worth now. That's what we call discounting. And that rate we use is the required rate of return, which means it is the minimum amount that is expected to be received from an investment. But these ones, we are going to see them as we go through. I'm going to first show you how we get the required rate of return. Most of the books give the computation of this required rate of return at the last, when we have already gone through the conversion of these or discounting these inflows. But me, I'm going to make sure I give it at the beginning so that you know where do we get this required rate of return, so that when we are computing or when we are discounting these inflows we are getting, you know where we got that, and these things are examinable. What I'm going to be giving you is examinable, and you are going to get it at the beginning, so that by the time you go through the computations of capital budgeting decision, you will be able to understand where these things are coming from. So we are saying that when wealth is maximized, the market will view the firm in the most favorable terms. Therefore, its share will fetch a high price possible. Since the market is the barometer of the society, then the market per share will reflect the intrinsic value attached to the firm by various interested groups. By discounting the cash flows to the present worth using the market capitalized rate, that is what we call the required rate of return. That's the discount we are using, the discounting rate. The objective of wealth maximization overcomes the weakness of not taking into consideration the time value of money. Remember, here we are discounting what we are expecting to be receiving as in the inflows from the investment we've committed. So we are discounting that money we are receiving every year, so that we know how much will it be now. By doing so, we are considering the time value of money. That's what we are going to be looking at. So the reason why in the next video I'm going to be taking you to the cost of capital and the capital structure is because I want you guys to understand how we get the required rate of return. That's what we are going to be having at hand. These things are examinable, and we are going to be starting with things that are really important, because I don't want to take you through the investment decision before knowing where these required rate of return are computed from. This required rate of return, remember, we borrowed the money from banks and the owners. When we borrow that money, we expect that income we are putting in the business, we expect that we are going to be getting some money, as in the inflows, upon operating that capital we've got. So we are expecting, we are assuming that what will be the minimum that at least we should get every year, so that we can be able to make a profit out of the capital we've put in the business. That's what we are going to be computing, and it's within here. So the next video is going to be about the cost of capital, and from the cost of capital, then I will take you how we discount everything, and when you've known that, we can go ahead to evaluate the projects within the investment decision. That's how I wanted you guys to appreciate the fact that you first know where the required rate of return is coming from, and when we use it in the capital budgeting, you will also be aware of what we are going to be handling. Thank you for watching.